Dear investors, momentum of retail investors coming into the market has been strong, and we do expect it to remain strong going forward. Now, it is important to look at this because this is one space from which we are getting strong new money into the market, which is keeping the markets up. There is money being made, and IPOs are proving to be successful. The current period is witnessing a fresh crop of tech companies getting listed. Zomato has completed its issue successfully. Paytm and others are there in the pipeline. The other space that is continuing to see strong interest is the chemical space, and several companies are getting listed and successfully. Going forward, the large IPOs that we do expect to see is, let's say, something like an LIC from the government. Overall, this could be an all-time record year for IPOs, and with several of these to probably figure amongst the top 10 in terms of size of monies raised. Now, these are well-known brands, and they are drawing in new investors. While continued buoyancy in corporate profits and that is supporting markets and in turn giving confidence to new investors coming in. IPOs in the past have been the favorite way for first time into the market investor to get in. And we do believe that the current crop of IPOs should prove to be the same, prove to do the same, and that's one reason for us to believe that the buoyancy that we have seen in the demat accounts moving up over the past period could very well continue. Especially if the other large IPOs list at a premium and investors make money just like they seem to have done in the Zomato's case. This may prove to be the inflection point for equity ownership in the country. Equity ownership as a percentage of overall savings are small in this country, have been stuck in a small range for a long period of time, and they could go up. And more importantly, a larger percentage of the population could be invested into equities. This we believe is healthy. It is about time the country changes from, let's say, the country of savers into country of investors and support a climate of risk-taking. That is essential if entrepreneurship has to take stronger roots. The country has developed a good ecosystem of startups for venture capital, private equity funds, definitely gaining in importance and prominence over a period of time. However, most of this money is money sourced from abroad, and it is about time that the domestic money seeks out and benefits from good entrepreneurs amongst ourselves. Lower interest rates do encourage this trend. Indian risk-free rates have dropped by 2%, let's say, over the past 10 years or so. More importantly, the rates at which individual investors can transact, the bank deposit rates, savings rate, etc., have dropped even more sharply. Debt mutual funds may have delivered strong returns as interest rates dropped because of capital gains on what they were holding. But over time, the returns from debt mutual funds would tend to look similar to the then prevalent yields. Traded debt instruments, because of the volatility, have also become more risky. While the next interest rate changes are expected to be up, especially as economy normalizes and inflation concerns reemerge, and I agree. However, I do believe that over the next 3 to 4 years, the yields could be lower than the present, given that our inflation expectations delta is reduced versus the West, and our domestic interest rates are still relatively too high. The fact that the population seems to be accepting lower interest rates very well would aid the trend. Moving on, over the past period, there have been some good things on a global basis which have been beneficial overall for India. The first being US, trying to limit imports from certain Chinese provinces. India benefits, that province makes a lot of cotton products. This really helps Indian cotton producers, the product manufacturers such as bedsheet, towels to gain market share in that geography. Obviously, stocks in that space have been doing well. In general, exports have been the sweet spot in the economy. For a long while, exports were in a range, but now it seems we are coming out of that range. Spaces like cotton textiles, steel, chemicals, and pharmaceuticals are doing quite well. The second point is the proposed global tax on MNC income, of 15%. So as to make all incomes accountable to tax, and reduce the relevance of tax havens is again something which is positive, and overall tax policy in the country could look better going forward. It removes taxation uncertainty, and if the buoyancy is good, maybe the lower corporate rate could sustain for longer. Third is the Chinese crackdown on their internet companies for, I think, very relevant reasons. Now, this may be helping some of the global monies into other EMs, including India. We have spoken about this in the past. Two markets where the presence of tech is significantly higher is the NASDAQ, the US market, and the Chinese market. And whenever tech comes into focus, these are the markets which do relatively better, and we trail in performance. But then, if one of these two markets have its issue, obviously incrementally, it's a positive for us, especially in a situation where many of our tech companies are also getting listed. These factors and continued improvement in COVID situation has helped the market do relatively well in the past period, and also on the absolute basis. Indian market, which was amongst the worst performers when our COVID situation was looking very bad, has again climbed back and is now more in the middling space. Going forward, the large equity issuance that we are seeing should be expected to change the focus away from secondary markets to primary market. It always happens, and result in a period of consolidation on the larger indices. And with limited upside on primary indices in the near term, we do expect to see continued stronger performance in the broader market, in the not so large cap space, for factors that we have discussed in the past, and they continue to sustain, which include government policy action, which include buoyancy in profits, and so on. Retail focused financials in spaces like microfinance, gold, SME, and other retail could do well as concerns over asset quality recede now that COVID is behind us. And also the pharma space, where valuations have remained in a range over past several years. While the leadership may have changed over the period, but valuations have more or less remained in a band. And we could see, this space do well, going forward. Export-oriented businesses should do well. That's a part of the economy which is doing well. Players in this space would or should be expected to get more investor attention. And lastly, buoyancy in the market also improves the outlook for broking, iBanking, PE, asset management, and wealth management businesses. So, that's the other space that we believe could see positivity. Quarter 1 result season has started, and the first flush of results from the IT companies have been more or less in line with expectation. Some ahead, some behind. Overall, in line with expectations. Smaller ones actually have done, significantly better than expectation, a tad ahead of even larger caps in terms of performance. While the impact of second wave is seen in the numbers of consumers, several consumer companies such as Asian Paints, Jubilant Foods, Havells have surprised positively versus expectations. Companies are generally saying that June has been good, and July till date has been quite strong. And that is giving a lot of heart to the markets. Retail brokerages have done well. Cement companies too have delivered results as we speak, and they have delivered good numbers. The price buoyancy there has been better than what people expected. We continue to see strong earnings growth going forward, after the first quarter into the second, third, and fourth quarter, as recovery from COVID continues, and hopefully the third wave is contained. It started in other parts of the world. Some say it can be larger than the second, but let's see how it pans out in the country. Our vaccinations have crossed 40 crores, 6+% people have gotten 2 shots, and the sero surveys have pointed out to over 60% of population having developed antibodies. That should keep the third wave in check, and if the earnings come out in future, we do believe markets could hold. As of now, with just first few results from the earnings season, we do believe overall the expectations for financial 22 on earnings would hold. This is a big year in terms of EPS growth, from 21 to 22. In terms of the markets, we do believe at current cost of capital and earnings momentum that we see forward, the valuations do look sustainable. This is something that we have been talking about over the past several months. At present, at higher levels, we continue to believe that these levels are sustainable. We continue to note that a quarter wiped out for a business impacts the value of a surviving business by just about 1%, while a drop in interest rates by 1% increases the valuations depending on the nature of the business, maybe in the range of 15 to 20%, depending on assumptions. Moreover, the other point to note is that the composition of the index has been changing over time in favor of better quality of businesses, that support higher valuations. So both of these effects need to be penciled in, and then the current levels will look much more sustainable. Interest rate increases, like we have spoken earlier, seem to be sometime into the future. We have seen actually some countries in the world, including China, relax monetary policy rather than tighten it. In the Indian context, we do believe policy normalization at the earliest could start maybe after October. We continue to work with an index target of 16,500 that we have been talking about, with maybe some amount of an upward bias for this fiscal. A simpler way to look at it is expect from these levels 0.5% to 1% kind of compounding in the large cap indices, and maybe close to 1% kind of compounding in the mid cap indices as a thumb rule. There is another interesting thing that we want to share. We have been talking about industry leaders and that they have been doing relatively better. Now we have some data to substantiate that. an analysis. EMI did that, analysis of 3,000 non-financial company shows this. If you divide these 3,000 companies in 10 deciles, 300 companies in each decile, you would see the top 3 deciles, 900 companies in total, were impacted for much shorter period versus the rest of the companies and came back very sharply. Okay, and are now making record profits and a large jump over the earlier records on a quarterly basis. Okay, this is the part, the 900 odd companies are the relevant part for the market participant. They form most of the indices. They form most of the portfolios, and since they have gained over the past period, the markets have reflected the same. Now, as the economic growth takes root, we do expect other spaces to revive. However, much of the gains in terms of market share for the top 3 quartile companies could sustain, and could prove much more permanent. Hence, we believe that in investing, the industry leaders, it need not be just the leader, but maybe one of the two, one of the three, would need to be focused on, as we do expect them to do relatively stronger, even in the coming periods. Buying on dips continues to be a good strategy. As broad market has reflated, and going forward, money making becomes incrementally more difficult. We do expect investors to favor professional money managers, going forward. Thank you and happy investing.